record small change करायचं होतं तिथं. हां. Hi, I'm Professor Ashok Patil and welcome to Corporate Valuation course. This course is, as you can see in the board, is the 4th-term core finance course and the course code is 4FMC03. As you can see that corporate valuation is an important course in this particular finance domain. As the term says, corporate and valuation, it's a valuation of the firms. And it's very important course because you can see that when the mergers and acquisitions happen, large companies want to buy certain small companies for the expansion or diversification. They need to know what is the value of the firm, what is the value of the assets, what is the value of the equity, and what is the value of the debt. Now, this particular thing is very important because company has to take the strategic decisions in order to arrive at a particular valuation. Now, having said that, this particular course has the objective of applying the concepts from time value of money to value the firms. As the term value is the bundle of benefits which are generated in the future, and we need to discount it so as to find out the value of that particular future cash flows today. Now, therefore, we can just see how the modules of this particular course are arranged. You can see that the first module, which is time value of money, the time value of money is important, as we said that calculation of value is to be done from the future, and therefore we need to discount the cash flows from the future to present time. Second module which is there, which we can talk about, is the drivers of the value. So what actually decides the value of the firms? So these are two things which are factors: the ROIC, return on invested capital, and the growth of the revenue of the firm. These two factors are also considered in the module number 2. Module number 3, definitely we need to discount the cash flows, the future cash flows, and therefore we need to see that the cost of capital, the appropriate cost of capital is used to discount these future cash flows. If we don't determine the cost of capital properly, then we will not be able to calculate the value of the firm appropriately. Similarly, we can see that the module number 4, which is calculating the value of non-operating asset, because when we calculate the cash flows of the firm, we'll be calculating the operating cash flows of the firm in the future, and then we need to add the value of the non-operating cash flows to this particular thing. So for example, I could write it here that the value of the firm is equal to value of the non-operating cash flows and value of the operating cash flows. So we know that in order to arrive at the value of a firm, we need to have two components. One is the value of the operating firms and value of the non-operating cash flows. Now, when this done, then we know that now we can see that are there any other alternative ways to value the firm? Maybe we can use the discounted cash flow method, we can use the multiple valuation method and then compare. The model number 5 will take about the calculation from different analysis of the DCF and non-DCF methods and then compare them. Build up the scenario to see that how the scenario changes will change the value of the firms. And the last one, the relative valuation techniques. So when we have normal discounted cash flow techniques, we also have relative valuation techniques where we can see that what other companies are being particularly taken over recently, and then we can see that what is their value and compare accordingly with the present value of the firm. And this is how we'll be actually doing module 6, and this is how the course stands. Today, we are going to talk about the module 1. So I'm going to talk about the time value of money, which is the module number 1, and how this time value of money is important as we have seen earlier. But many times, although we have covered some of the concepts from the previous courses, we need to see that this particular concepts are touched upon once again. So let's go to the presentation on the time value of money. See, the basic idea behind time value of money is that the rupee today is more valuable than rupee tomorrow. Say, for example, I have rupees 100 today in my pocket, and I keep it in my pocket only. And after 1 year, if I want to use that 100 rupees to buy a particular thing, I'll not be able to buy the same quantity or same quality of the product which I could do 1 year before. So that means the value of the money has decreased over the time, and that is what the idea of the time value of money. So the value of the rupee erodes over the period, and if you want to take a decision today for a particular firm to see that whether I should buy it or not, we should know that how the future cash flows, which are less in value, right, come to today, what happens to that particular value of the cash flows. And this is how we will go ahead. So this is the basic idea. We are going to just briefly touch upon, because this is going to be an overview. We can get into details once we come to the assignments. Now, what actually happens when we said that the value of the money decreases in future? So what actually happens? So why is it so that why the value of the money should decrease in future? Just imagine that, as I said the previous example, if you are having that 100 rupees in your pocket and you don't want to let go that 100 rupees today, because you want to see that whether this 100 rupees can safeguard me in the future with respect to the inflation, with respect to my uncertainty, the risk of the cash flows which is there. Remember, I ask you to lend me 100 rupees today. So what are the things which will come to your mind? Okay, if first thing is that if I'm going to return certain amount back to you after 1 year, how much that should be? It should be 105, 106, or whatever number. So that has to be decided by the opportunity cost or the inflation in the economy. So if the inflation in the economy is 4%, you will definitely would want that 4 rupees is given to you after 1 year. So if you are lending me 100 rupees, you are expecting that at least inflation should be covered so that I can buy the same goods after 1 year. And that is what the first point is. So inflation erodes the value of the money. That is the point. Then second thing which we can also talk about is even though inflation erodes, and you may not be willing to actually lend that money because you want to consume tomorrow. I mean consume today, sorry. You want to consume today, not tomorrow. If you have 100 rupees, you want to consume today, then consume tomorrow. That means that you need to get compensated for letting go the consumption today. The preference for consumption will decide the percentage which you will be asking as a return from your 100 rupees investment. So we can see that the second point is that you would like to prefer to consume today than tomorrow. And of course, third thing, as you have lent me, but you do not know whether I'll be returning you that 100 rupees back to you. That means there is some risk or uncertainty in the future cash flows. So you need to actually cover those also. So we have three prominent points which are actually deciding the erosion of value of cash flow in future, namely inflation, preference for consumption today, and the last one is the uncertainty or risk. Uh, you can see that obviously if inflation increases, then your value erodes more. If your demand for consumption today is more, obviously the value will decrease. And if there is a higher increase, a higher risk perceived, then obviously the value erodes more. These are the implications. And as we have seen, there are two ways which we can do present value and future value. That means the cash flow which are generated in the future can be taken today backwards with the present value technique. And if the cash flows are generated today and you want to forecast the cash flows for future, then those cash flows can be taken using the future value formulas. So what is the present value principle and why actually we need to do that? So as I said earlier, when the firms want to take over a particular company or there is a merger happening and we need to see what is the value of an asset of the firm, they need to determine today the cash flow generated by the assets will be after few years. That means maybe starting from next year onwards, the cash flow will be generated by the asset. Now we want to actually determine what is the value of those cash flows today so that we want to take a decision today about whether we should buy these assets or not. And therefore, present value concept is important for comparison of different cash flows at a particular given point in time. So if you want to take a decision today, we want to calculate the present value of all the cash flows today. That is the idea. Now you can see that there are different ways the cash flows happen. So the assets generate the cash flows in future, but then there could be different ways the cash flows are generated from the assets. But for the sake of understanding the entire gamut of the cash flows which are generated, we can look at the classification as single cash flows, annuities, growing annuities, and you can see that perpetuities and growing perpetuities. These are some classification. As we can see that the first point which is there is simple cash flows, that is a single time cash flow. One time cash flow is generated and what is the value of that particular cash flow today. Similarly, in the annuities, we have the constant sum is generated over what is the value of that particular cash flow today. That is what the annuities will do. And of course, as name suggests, growing annuities, there could be some annuities are not constant, but growing at a constant growth rate. So maybe when the cash flow is generated 100, and then we can say that 100 generated next to next year, that is year number 2, will be 100 into some growth rate, let's say 5%. And therefore, we know that the cash flows are changing over the period, but growth rate is constant. In that case, we can use the growing annuities. The next interesting factor is that, as we said, that firms are an entity which are perpetual. They don't die. And therefore, we can also make an assumption that if the firm is going to continue, what the cash flows need to be forecasted accordingly for perpetual period. And then in that case, we need to see that how perpetuity cash flows are valued. And the last one, so we can see that whether we can see that growing perpetuities also could be calculated. Now let's look at the the first part, which is the compound interest. We have seen from the beginning that the cash flows are either simple interest or compound interest. So the compound interest is basically talking about interest on interest. So the interest itself is compounded. So we can see that in simple interest, we are not compounding the interest generated. Suppose, for example, 100 rupees is invested by you and 5% interest is there. Accordingly, after 1 year, the amount which will be returned to you will be 105. In the second year, again 5, because the interest which you have generated in the first year is not compounded. But that is not how the real life works. And we can see that the compound interest applies. That means the interest which is generated in the first year, that is 5 rupees, will be again used to invest, reinvest for the second year, and therefore on those 5 rupees also will get an interest of 5%. And that's how the compounding formula happens. We can see that future value, right, is equal to the present value, that is the cash flow which is generated today, multiplied by 1 plus R, and the number of times the compounding is done. I mean, the number of where the amount is invested. And therefore, we can see that future value is equal to present value times interest rate per annum 1 plus, because this is in the decimal form, and n is the number of periods the amount is kept in the bank or amount which is invested for those many periods. So, for example, if we are having present value of 100, 1 plus 5 is the 5%, which is in decimal form comes to 0.05, and suppose it is taken for only 1 year, then you can see that the amount which comes to is 100 into 1.05 is equal to 105. And this is a particular thing which normally happens, and it's very easy. Similarly, we can also calculate the present value from the same formula. If we are having future value is equal to present value into 1 plus R raised to n, and similarly we can just rearrange the terms to get present value is equal to future value into 1 upon 1 plus R raised to n. And that is how we use this particular simple compound interest formula to determine what is the present value of the cash flow generated by the assets of the firm. Now we can take certain examples. As you can see in the board, say for example, one-time cash outflow. Suppose you invested 100 rupees today, and we want to determine what is the value of that 2 years down the line at a given interest rate. And let's assume that the interest rate for the period is 10%. Is the 10%. Now we can see that the compounding happens once here and once here. So 2 times the compounding happens. So we can calculate the future value of a particular cash flow using now this formula FV is equal to PV into 1 plus R raised to n. And alternatively, since we can see that this is going to be a factor with varying R and n, one can generate the tables, and as you have seen in the previous courses, these are called future value interest factor tables. And if these are calculated, these are called as present value interest factor tables. So the second one, which is the using the table. So we can calculate the present value or the future value of the cash flows using 2 methods. One is using the formula directly, and second is using the FVI table. So I'm going to illustrate this particular example, and then you can see that using the formula FV is equal to PV into 1 plus R square, and then you can see that with formula FV is equal to PV into 1 plus R raised to n. In this case, PV is 100. As you can see that the interest rate is 10%, so it is 0.1, and the amount which is kept is for 100. And then you can see that this is 1.21, and therefore the amount comes to 121. Now, you can actually very well calculate for different periods. So maybe for 2 years, 3 years, and what changes is only 2 points. One is R, that is this 10%, or the second one is N, which is here 2. So we can see that by changing values of R and N and plugging in those values in the formulas, we can calculate the future. It's very easy. And similarly for the tables, you can use this FEIF table, and you can see that N is 2 and I is 10%. Let's look at how to do this for the first time using the tables. Yes. Now we can see that in this table, the N is 2 and R is 10, and you can see that this is particularly 1.21. Just plugging in those values into the table, we can see that that 1.21 is taken from the table, and you get the value of 121. Very easy. I think we can calculate this future value. Now applying the same thing, you can actually calculate the present value of the cash flows. So suppose the cash flow which is generated only one time cash flow, please remember this is the one time cash flow which is generated at the end of second year. What is the value of that particular cash flow today is what the question is, and at the given interest rate of 10. Now it's very easy, you can actually use this formula and you can simply plug in the values. Future value is 100, 1 plus R is to N 1.01 square, and you can get the value of 82.64. Similarly, we can look at the present value interest factor table and calculate the values. Let's do this example as well, looking at the values from the tables. And now we have to look at the table which is talking about the single cash flow PVIF. You can see that PVIF and this factor, and we need to look at the N is 2 and interest rate is 10%, and that comes to be 0.8264, and that is what exactly can be plugged in to find out what is the value of the present value of that particular cash flow. So we see that the present value and future values can be calculated using two methods. One is that actually using the formula, or you can use the tables, which are very convenient when we don't have the calculator many times. There is one more thing which is an indirect method of calculating the value of, say for example, what period is taken for a particular cash flow to double itself, and that is a very simple formula which talks about 72 by R is equal to N, and you can just plug in the values and calculate what is the period in which my amount will be doubled. Say for example, you can see that N is equal to 72 by R. Suppose R is 10%. Suppose R is 10%. What is the period in which my amount will be doubled? So how it will be calculated? 72 divided by 10% is giving you 7.2 years. So you know that in 7.2 years at the interest rate of 10, approximately the amount will get doubled. That is 10 will become 100 rupees will become 200. Alternatively, we can also use the other way around, that if N is equal to 2, right, 72 is constant here, and R, so same thing which we can look at, just I am plugging different values here. So if N is equal to 2, 72 is constant divided by R, then you can calculate R is equal to 72 divided by 2. So that means 36% need to be given in order the amount to be doubled in 2 years. This is how a handy tool, it's a trick which is used, but normally for the cash flows generated by the firms, we should use the formulas or the tables. So now look at, so far what we looked at was the cash flows which are generated at one time. Let's take a case where the company's assets are generating the cash flows every year. Now, obviously the question will come, is the cash flow same every year or different? So if the cash flows are different, there is no shortcut formula for using or calculating the present value of those cash flows. But if the cash flows are constant for every year, then we have a case which is called annuity of the cash flows. And we'll be seeing that also. Now look at what happens if the cash flows are different, which is the case normally when we see that firms generate cash flows, the firms assets generate the cash flows every year generated are different. So if the cash flows are different, can I use the annuity formula? The answer is no. If the cash flows are different every year, you have to calculate the present value of the cash flows individually. There is no shortcut formula. Please remember, because many times we see that this is the common mistake which is done. So the annuity formula is on the premise that the cash flow generated by the assets of the firm over the period is same, and that particular thing is called annuity. There are two types of annuities. One is ordinary annuity, that happens at the end of the each period. So the cash flow generated by the firm are happening at the end of the period. And when it is called annuity due, then it is called when the cash flows are generated at the beginning of the each period. And very simple, but when we'll see that how the formula works in the background, we don't need to get into nitty-gritties of the derivation of the formula, but you can see that it's the constant amount which is A, which is there, and you can see that it is taken the present value after 1 year, 2 years, and first year, and the today's cash flow. And if you use the mathematical formulas, the final thing which comes is this. So ordinary annuity, you can see the future value is the constant amount which is generated by the cash flows by the company, and using this bracket, and these tables are also, these values are also available. And similarly, you can see that present value of the cash flows, this formula is generated using the. Now let's look at one of the examples. Okay, so you can see that the difference between the annuity, ordinary annuity, and annuity due is simple multiplication by 1 plus R. So for example, if you calculate the future value of annuity due using this formula, ordinary annuity is calculated, just multiplied by 1 plus R. Similarly, you can see that the present value of annuity due is equal to present value of annuity, ordinary annuity multiplied by 1 plus R. Now, when we actually deal with these calculations, normally we make adjustments to see that everything comes into the ordinary annuity, and then we can convert the remaining cash flows using the normal present value formulas. Now perpetuity. Now this requires some explanation. Say for example, we see the present value of the annuity is equal to A 1 upon R minus 1 upon 1 plus R raised to n, right? Now this particular formula, now we can see this is the n is the number of periods the money is kept or invested, R is the interest rate, and we are talking about the case of perpetuity. What is the perpetuity? As we discussed earlier, perpetuity is the cash flows, stream of the cash flows which never ends. Assuming that the firms are not going to shut down, we say that the cash flows are in perpetuity. Now, if that is the case, we can use the annuity the same cash flows which are generated every year, but the cash flows are not stopped at any point. So we can see that when the cash flows are not stopping, the n tends to be infinity. So if you take n to be infinity, 1 plus r becomes very large, multiplied by r becomes very large, and therefore 1 upon this becomes tends to 0. So now we can see that this entire term tends to 0. If this tends to 0, that means what remains is a into 1 upon r, and that is what exactly we see it here. So using the annuity formulas, we can actually derive the perpetuity formula. So we have seen how these things happen, and this is the summary, and definitely you can look at the summary of the formulas, and we can use the formulas appropriately depending upon the cash flows generated by the assets. So just to summarize, the left side of the slide is talking about future value compounding and present value discounting. You can see that single cash flow, this is the formula. Annuity case, as we saw in the previous example. Similarly, annuity due, just multiply by 1 plus r, and we'll look at this sinking fund and growing annuity in the next lecture. And similarly, you can see that single cash flow, this is a formula which we have seen and solved one example. Annuity case, and you can also see that annuity due, only the difference is multiplication by 1 plus r. Now the perpetuity, you can see that perpetuity derived from this particular formula, and you can see that a upon r. Now the growing annuities, only difference is that r minus g. So you can see that r minus g is there, and one particular thing, 1 plus g raised to n. Now this is a particular formula which will be derived later in the subsequent classes, and then you can see that the growing perpetuities formula is a upon r minus g. Similarly, you can see that if n tends to infinity, this entire thing comes to 0, and therefore what remains is only this, and this is what exactly has been written here. So you can see that the cash flows which are generated by the firm will be discounted using either the formulas or using the tables. We have seen the different variations. One is the one-time cash flow, second is the annuity. Third thing is we are talking about the growing annuities, ordinary annuity, and annuity dues. All of those things which has been covered in different courses, but we need to look at these formulas once again, and that is why particularly we have included this particular module in this course, which is titled as corporate valuation. Once again, I would like to tell that what is the importance of time value of money in corporate valuation. As we said that mergers and acquisitions are happening day in day out. We can say that many companies are getting taken over by other companies, or there are mergers happening. People are looking out for buying the assets of another company, and when this happens, if you are at the helm of the affairs and you want to take a decision whether I should buy this asset or not, you must know what is the value of those cash flows generated by those assets today. You want to take a decision how the assets are to be valued or how much should be paid for that asset today. We need to know that how much cash flow is generated by that asset in future, and bring back the value of those cash flows today in present, because you want to take decision today. I think we can take a pause here in this particular course and come back next time to see that how these are actually applied in real time scenario. Thank you. सब डस्टर किधर है?